Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at three oversold S&P 500 stocks down at least 15% to consider buying in June. And those three stocks are Dollar Tree, McDonald's, and Lamb Weston. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into these three beaten down S&P 500 stocks to consider buying in June, I just want to do a quick market overview to give a better sense of what's going on as we turn the page and head into June. So all 11 S&P 500 sectors dropped on Wednesday, and the NASDAQ fell about 0.6% one day after closing above 17,000 for the first time. Both major U.S. indexes are still in the midst of really impressive May performances and huge year-to-date runs. And actually, the tech-focused index is still attempting its best May performance since 2003. But as I record this on Thursday afternoon, early afternoon, the NASDAQ was down about 0.6% again, and the S&P 500 was down about 0.5%, with the big downturn coming from Salesforce, which was down about 20% as I record this. So moving on then to some of the reason why we're seeing a bit of a downturn. U.S. Treasury yields are marching back somewhat near their 2024 highs. The two-year yield is at about 4.93%, which is down from Wednesday, versus year-to-date highs of about 5.05%. and up solidly from May's 4.74%. And then speaking of rates, the Fed's preferred inflation gauge is taking center stage on Friday morning. The PCE is projected to hit 2.7% in April to match March. And unless the year-over-year and monthly PCE data comes in way above or way below expectations, there's really little suggest that the inflation data is going to really move the market. Though rising bond yields come as Wall Street is once again slightly tweaking its rate cut outlook, traders are calling for a roughly 54% chance that the Fed keeps its core rate unchanged through its next three meetings. So that's June, July, and September, versus about 42% a week ago. So they're calling for slightly higher for longer, for a little bit longer than they were last week. So the levels to pay attention to heading into June, as the NASDAQ still trading above its 21-day moving average, and it's now below overbought RSI levels, though the downturn might take it to that 21-day. So we'll either see when more people taking profits off the table when you have over 50 S&P 500 stocks that are still up 25% in 2024, including some names up well over 30, 40, 50%. So we might see more profit taking heading into the unofficial start of the summer. And then it's up to investors to take advantage of those next downturns for the NASDAQ and the S&P 500, say to that 21-day or 50-day, or even if we pull back all the way down to the 200-day, that's when if you're a longer term investor, when you should most likely start getting a little greedy. And then the three stocks we're looking at today are actually ones that are already shaping up to be long-term buy and hold candidates that are beaten down pretty heavily so far this year. And it might be time to jump into these three stocks, as it seems like everyone else is running away from them at the moment. So the first stock up on the list today is Dollar Tree, which trades in the ticker DLTR. It's an ultra discount retailer that's been hit hard over the last year as its lower income consumers pull back on spending as inflation continues to squeeze their pocketbooks. It's down roughly 20% year to date. Overall, the company operates over 16,000 stores across most of the United States and Canada. The discount retailer also owns Family Dollar, which it purchased back in 2015, and it offers a wider range of price points. The company operates smaller format stores compared to, say, Target or Walmart, and that's why it has so many stores, and it's expanded relatively aggressively until more recently. It grew its revenue pretty steadily for a long period of time, and it's poised to thrive in the long run as more Americans look to save on products across all economic environments. The Dollar Tree chain, which though is generally located in the suburbs, caters more to slightly higher income customers looking for, say, party favors and seasonal decor and things like that. And it fared better than its Family Dollar business, which it also, as I said, Family Dollar is struggling more. Dollar Tree then said last quarter that it would close roughly 600 unprofitable Family Dollar locations this year. In addition, it's set to close about 400 Family Dollar and Dollar Tree stores. So there's some combination of those stores in various places. It will just not renew those leases. So while Dollar Tree estimates that the closures will reduce its top line by about $730 million, it estimates that it will help boost company-wide earnings by about 30 cents a share on an annualized basis. And most of then its new store openings this fiscal year will be Dollar Tree stores, which have better returns and performances overall. It's also worth noting that the company has taken a hit because it's noted that theft is hurting some of its business, and the headwinds of lower SNAP benefits, higher gas spending, the return of student debt repayments are all hitting its customers as well, though it's expected to be a little bit less shocking in the back half of 2024 as those payments just become kind of more embedded into the family finances or the consumer finances of those people. Overall, it's been struggling recently as investors look ahead to that slowing growth, and now might be time to buy. It's worth noting that Dollar Tree is set to report its first quarter 2024 results before the market opens on Wednesday, June 5th, so next Wednesday. Overall, the company's coming off a really strong stretch. It did 8% revenue growth in 2023, roughly 8% growth the year before that, and 3% growth prior to that, and then 8%. So a really strong stretch of top-line growth. And looking ahead, we're calling for about 2.5% revenue growth in 2024, and then another roughly 6% revenue growth next year. And then on the bottom line, really impressive, we're calling for about 17% adjusted earnings growth this year, and another 18% adjusted earnings growth next year, as it looks to, as I said, trim some of those unprofitable businesses, which is going to hit the top line a bit, but improve the bottom line significantly. Overall, its earnings revisions have trended down over the last year. So for 2024, its estimates are down roughly 4% over the last year, and down about 2% over the last year for 2025. So nothing really shocking, and despite it being down 20% this year, its earnings estimates for 2024 are only down about 0.4% since its last report, and about 0.6% for 2025 since that last report. It lands the exact strength number 3 hold at the moment, given some of those earnings estimate revisions activity. Yet 14 of the 22 brokerage recommendations we have are strong buys, next to 7 holds and only 1 sell. The company has a rather sturdy balance sheet as well, and is trading 30% below its average Zacks price target. The stock is now down 30% exactly in the last 2 years versus its sector's 30% climb and Walmart's 50% run. But this is faring better than Dollar General, which is down 42% during this stretch. But if we look over the last roughly 15 years exactly, the stock is up 671% versus the broader Zacks retail sector, which is up 560%. So a really nice long-term outperformance over the last 15 years for Dollar Tree. The stock is currently trading slightly below its 50-month moving average for only roughly the 4th time since 2019, and it has not hovered below this moving average for very long, as I said, over the last 5 or so years. And it's not a place it's really been for a very long period of time. The stock is trading below its 200-week and 50-week moving average, but it does appear to be finding some support, as I said, near that 50-month moving average and some of its recent lows more recently. And then it's also trading 34% below its highs overall in terms of its valuation, and 15% below its median at 15.6 times forward 12-month earnings. This also marks a 30% discount to the broader retail sector. Once again, it reports on June 5th, so next Wednesday, and now might be time to put the beaten down discount retailer on your radar, as a bottom could be in the near term. So once again, the stock's down 20%, its earnings outlook looks really strong. The top line is maybe suffering in the near term bit, but it's a store that's not going out of style anytime soon, even though its core customers are pulling back a little bit. So now might be a time to consider putting Dollar Tree on your radar, though you might want to wait until after its report next Wednesday to see what happens in the near term. Moving on to another stock that's been suffering as consumers, especially lower income consumers, pull back on spending. That's McDonald's, which trades the ticker MCD. The burger giant fell slightly short of earnings estimates at the end of April. The company also, on top of slowing consumer spending on the lower income side, it cited that the Middle East has taken a hit from calls to boycott the chain in response to its perceived support for Israel. The company said, quote, continued impact of the war in the Middle East more than offset positive comparable sales in Japan, Latin America, and Europe. The company's CEO said that the company is focused on ensuring that the food remains a good value for its consumers. So that's kind of the big push going forward, is that McDonald's is trying to get back to that affordability. I know from our own personal experience that you can now go to Chipotle and get a burrito bowl for less than a meal at McDonald's. So I think a lot of people are probably taking a step back and saying, is this worth the money? So this is something McDonald's really has to do in the near term. It is something they're trying to focus on, is having a unified kind of national approach for meal deals and various other promotions, even though most of its stores are franchised owned, so they can offer local kind of deals. So they're trying to remain laser focused on affordability is the goal for McDonald's and getting back to in the near term. The company said that its same-store sales growth still was 1.9% the first quarter, which was just slightly below expectations. And then they said more recently in mid-May that it plans to sell a $5 meal bundle this summer to try to draw back in those cost-conscious consumers, which is, another good sign. And they're still operating one of the most insane businesses around the world. They operate over 40,000 locations in 100 countries. The company could also continue to benefit from raising royalty fees for new McDonald's franchises in the U.S. and Canada for the first time in roughly 30 years. And it's worth noting, as I kind of alluded to, that 95% of McDonald's locations are owned by franchisees. And it's also worth noting, over the long period of time, the last, I'd say 10 years or so, despite all the talk about the, quote, health food craze, McDonald's is still doing very well, and it's been able to slowly tweak its menu and thrive during the digitalization of the restaurant industry. Its app was downloaded roughly 130 million times. The most recent data we have is for 2022, which blew away Uber Eats, which is at 60 million. So McDonald's crushing an app that also delivers food for every restaurant. And just in 2023, the company did comparable sales growth overall of 9%. And they're up 30% since 2019 in terms of a comparable sales growth. Looking ahead to 2024, Zacks estimates are calling for roughly 2.3% comparable sales growth and about 2.2% in the U.S. This comes, as I said, after 9% growth last year, and then 11% growth the year before that, and 17% growth before that. So really difficult to compete against Stretch, and they're still going to be able to grow solidly above 2% in terms of comparable sales growth in 2024. Overall, we're calling for about 4.4% total revenue growth this year, and then 6% revenue growth next year. And then on the bottom line, we're calling for about 2% adjusted earnings growth in 2024, and then a return to better growth next year in terms of 8% on the bottom line. And this comes against a big year of 18% adjusted earnings growth in 2023. Overall, its earnings revisions have trended lower since its last report. Its 2024 estimate is down about 1.7%, and its 2025 estimates down about 2.3%. So nothing shocking. And over the last year, it's still up compared. The 2024 estimate still up compared to where it was this time last year, and its 2025 estimates up about 3.5% from where it was this time last year. So though it's came down from its recent peaks and slightly from its last report, it's still up over the last year for both 2024 and 2025. This helps it land a Zacks ranked number 3 hold. And then 19 of the 32 brokerage recommendations that Zacks has are still sitting at strong buys, next to 0 sells for McDonald's. Overall, the stock is trading 27% below its average Zacks price target. with McDonald's down roughly 15% year to date. Looking back over the last 20 years, McDonald's shares are up 850% versus the retail sector's 460%, and the S&P 500's 385%. That said, it's only up about 25% in the last 5 years, so lagging the S&P 500 pretty significantly. At the moment, the stock is trading just below its 200-week moving average for the first time since the initial COVID sell-off in early 2020, and at some historically oversold RSI levels, so certainly worth considering McDonald's just on those facts alone. And then if we look longer term, it's trading right on top of its 50-month moving average, and the last time it hit these levels, which was the 50-month moving average, was right at those COVID lows. So this could be a time that the broader market's saying this is time to buy McDonald's. The business is strong. It's facing some near-term headwinds. We're not going to let it go too much lower than this level. As I said, it's never fallen below the 50-month moving average over the last 20 years. I'm looking at the chart right now. It's found support there pretty much every single time. So we'll see if that proves the case in the near term. And it's sitting at its most oversold RSI levels over the last 20 years since the COVID lows. It's also trading at a 35% discount to its highs in terms of forward earnings. It's trading at 19.8 times forward 12-month earnings. This is its lowest level over the last 5 years outside of the COVID sell-off, and some of its lowest levels since early 2014 as well. And McDonald's is also one of only roughly 65 S&P 500 dividend aristocrats, which are companies that have both paid and raised dividends for at least 25 straight years. And McDonald's dividend is currently yielding about 2.7% right now. So certainly worth considering McDonald's at this point, as it trades at long-term discount and sitting at some levels that might attract longer-term buyers across the wide spectrum of investors at the moment. So now we're going to move on to the last of our three beaten down S&P 500 stocks to consider buying in June, is that is Lamb Weston, which trades the ticker LW. Lamb Weston's frozen potato business is boring, but it's been booming, yet its stock is down 21% year to date. It fell well short of our earnings per share estimates, which was its fiscal third quarter of 2024. Came in 14% below our estimates. The frozen potato products company cut its guidance amid transitioning to a new planning system. So the company said, quote, "The transition to a new enterprise resource planning, which they call ERP system in North America, negatively impacted our financial results in the quarter by more than we expected." This was from their CEO, Tom Werner. The ERP transition temporarily reduced the visibility of finished goods inventories located at distribution centers, which affected our ability to fill customer orders. In turn, this pressured sales volume and margin performance. While we are disappointed with the magnitude of the transition's effect on the quarter, after implementing system adjustments and modifying the processes, we believe the impact is behind us as our order fulfillment rates have normalized. So this could be just a temporary setback that then longer-term investors can take advantage of. Lamb Weston lowered its sales range to about $6.54 billion to $6.6 billion for 2024 versus about $6.8 to $7 billion before that. Overall, it's also coming off a really strong period of growth, and we're still calling for 23% growth this year in 2024. This is on top of 30% growth last year and 12% growth the year before that. That said, after those three booming years, we're calling for just 3% revenue growth in 2025. But on the bottom line, we're calling for 18% growth this year and then another solid 12% growth next year. Its earnings revisions have slid relatively significantly since that last release, with its 2024 estimate down about 7% and its 2025 estimate down roughly 4%. Yet over the last year, its 2024 estimate's still up roughly 12% from where it was this time last year, with its 2025 estimate also up roughly 12% from where it was this time last year. So despite the near-term pullback on the bottom line revisions, overall it's still looking a lot better than it was this time last year. It currently lands a Zacks ranked number 3 hold, and all 10 of the brokerage recommendations that we have are sitting at strong buys. Yet still the stock is down 21% year to date, and it's trading 31% below its average Zacks price target. Overall, the stock's up about 45% in the last 5 years, and this is versus the consumer staples sector's roughly sideways movement. And this does include some big swings, with it still up 28% in the past 2 years. The stock is currently, it found support relatively recently at the 200-week moving average, yet it seems to be fading back possibly towards that level at the moment as it sits at relatively historically oversold RSI levels. And then in terms of forward earnings outlook, it's trading right at its COVID lows. It's trading at 13.8 times forward 12-month earnings, and this is a 56% discount to its highs and a strong discount to the broader consumer staples market, which trades at 17.2 times forward earnings. This is despite that really impressive outperformance. Overall, Lamb Weston's been in business for roughly 70 years. It spun off from Conagra back in 2016. It's one of the largest suppliers of frozen potatoes in the world, selling really an endless array of different potato-based offerings. Its potato products are staples at restaurants and retailers around the world. Simply put, fries and potato-based foods are really not going out of style in the U.S. or internationally, and it might be a good time to consider putting Lamb Weston on your watch list or perhaps buying it as we head into June. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.